So thank you very much, Jeff, Judy, and Misty for inviting us to this presentation. Doug and I are really excited. I'll start off by giving a little bit of the background about why Doug and I have created this software called Risk to Value. And the title of our presentation is Your Use of Funds Fundable. And then I'll jump into an agenda slide. So I've worked in startups. This first startup I was working in had the largest IPO of the year when we went out. And I was responsible for strategy and a general manager. And subsequent to that, I've worked as an investment banker. I'm a limited partner in a fund. And Doug also has had that experience where he's taken a company, from 0 to over 200 people, trading $65 billion a year at the mercantile exchange in options, and just had a very, very successful run. So we've been on that side of the table, but we've also been on the investee and the investor side of the table, which has really been exciting for both of us. Now, while we've sat on both sides of the table, we've seen a problem. Going back to what Misty said, where often there are entrepreneurs looking for investment and there are investors looking to invest. And what happens? Like, there's a lot of conversation, there's a lot of questions, it takes a lot of energy and time, and nobody's happy with the process. So we're trying to help the entire industry develop a set of software with expert best practices to reduce the friction of getting funding. And so we love what the team is doing, and that's what we're trying to help out in. So if you go to the next slide, the agenda, we're going to have three major areas that we're going to cover today. First of all is the risk to value, the process. Is your use of funds fundable? And then we're going to talk about the investor summary builder, and it's different than an executive summary builder, as Misty has spoken about. And the last thing we'll talk about is how to get ready for investors from a due diligence perspective, because they are going to ask you lots of questions, and if you're prepared, the chance of raising money goes up dramatically. So that's the quick agenda that we're going to talk about. And Doug, would you like to talk a little bit about your background as well as the first question we have?
Yeah, as Chris alluded to, I spent my first life in finance and technology before they called it fintech. And I've been also on both sides of the table, both as a founder, angel investor. I've invested across the entire spectrum. So here's a question on here we wanted to ask everybody. Before we kick it off, sorry, there we go. Who's doing that? So just to put context in the room for everybody. So of everybody who's attending tonight, we've got 65 companies that are currently raising money, and all 65 of those have already raised at least some money to date. A total of 7.9 million has been raised in the room, which is really impressive. Already, congrats to everybody who has accomplished that. There's been a high, someone's raised over 3 million in the room, as well as $500 with an average of almost $250,000. So there's quite a bit of traction already in the room. The question I have for everybody to answer is, okay, if you've already raised money, or you're about to raise money, or you've got the money, can you forecast your enterprise value increase after spending the money that you've just raised? And with a show of hands, Maggie's gonna take a quick count. So can anybody do that, or has anybody even thought about that? As she is compiling those, I'm gonna move on. So what we're here to talk about is the use of fund strategy. And why the use of fund strategy? Because your entire business strategy is contained in your use of fund strategy. And what do we mean by that is, it's how you're going to spend your money and your time. And so it is your use of funds, both your money and time. And this is where the entire strategy of your whole business plan lies. And while a lot of investors and all investors have to have a nice deck and they want to hear the problem and the solution, at the end of the day, an investor's decision is based on what is in this use of funds, the milestones, the goal, and what you're going to do with it. And that's what we're focused on. And in all of our background, both Chris and I, we've focused on risk-adjusted return on investment. 8 raised hands. All right, good. So that's actually really good. Just to come back, we had at least 8 people say that they could forecast enterprise value increase. So that's pretty good. Coming back to the process. So the risk to value process is a process that creates a strategy which prioritizes money and labor by risk adjusted return on investment or to maximize the company's valuation. One thing I want to say before we even go further is a lot of times you'll hear entrepreneurs say, oh, you know, the investors, they just don't understand my idea. They just don't get it. And everybody's into your dream. Like everybody believes in the dream, but what we're focused on is you still have to go from A to B before you even get a chance at even seeing that dream. And so we love it because we're into the dream, but unless you have a plan to get from here to the next step that's going to really increase the value of the company, it's not going to be investable. And so what is risk adjusted ROI? So we'd like to do this interactively. We're going to do as best we can because of virtual, but we're just going to speak to it. So the question comes up, how are you supposed to decide between 2 seemingly identical investments? On the left, it looks like a regular old bond that pays 10%. On the right, you got a regular old bond that pays 10%. So the question is, how am I supposed to decide on which one to pick? A lot of people come up with various answers, but there's really only one, and it is which one has the highest probability of getting this 10%? Meaning, which one has the highest risk-adjusted return on investment possible? If the one on the left only has a 50% chance of getting the 10% and the one has an 80% chance on the right, it's a no-brainer that you take the one on the right. And investors aren't looking at the big number on your plan. They're also thinking about what is the risk and what's the probability that that person or that company or that entrepreneur is going to get to that next milestone. Okay, I'm going to ask a question to everyone before I speak to the slide. So there's an average number out there that every company on average needs in order to get to a successful exit. This is dilutive capital. So this is the amount of money, not debt you would borrow, but the amount of money you would have to dilute yourself and raise in order to get to a successful exit. It's an average for a tech company. So while I'm speaking to the slide, if everybody could type down into the chat a number that they think will, by the time we get to the end of it, we will see what everybody has to say. So 2 important data takeaways here. 1, the average angel pre-money valuation continues to grow while the median stays steady. And the other one is that there's still strong increases across the entire range for early stage VC valuations. Okay, now this is data that gets us through 2020 and it's just before COVID. So a lot of people ask, well, what's changed since COVID? You know, things have reoriented, things have aligned a little differently, but in general, it's still similar overlying conditions, which are, there is a ton of money out there, but if you notice, the median is still steady, which means that the average is higher and that, I'm sorry, the average is not higher, but the number of deals that people are putting money into, they're piling into fewer deals. Okay, so what's the average? We got $1.5 million to get to exit, $750K to get to exit, 10 million, 1 million, 3 million, 200 million, 500K. So the answer is $41 million. And why this is so important is, and you heard Misty and Judy speak to it, when an investor in a VC in an early stage gives you money to invest in, they're keeping more money for you off to the side because they know you're going to need it. They know you're going to need it. So if you walk in within a plan and you say to a potential investor, yep, $5 million, that's all I need. I'm done, man. We're going to IPO. This thing's going to be awesome. It's probably the end of the conversation. So you need to go into a meeting with an investor knowing that they know that you're going to need more money and have a plan for what you're going to do about it. Last year, this is through the end of last year. All the trends have continued. And again, the big takeaway, guys, is just this. Investors are seeking great deals. There's plenty of money out there. Last year, there's over 136 billion. There's going to be probably more this year. But the line to look at is the number of deals is going down. And again, it's because There's a lot of money sloshing out there, and investors are looking for good deals, but they aren't finding them, and they're piling into the same deals. I want everybody in the room to take a real close look at this one, because this is every founder's nightmare, which is a straight dilution from the beginning down to the end, where an average founder exits with about 10 to 11% of the company. So the only thing to remember is that you're going to be diluted no matter what. The important part is, what are you going to do in the very beginning so that this line isn't steep down to the right and it's more shallow over to the right? Because if you do the right things in the beginning, you will minimize that dilution. This is just a distribution of where investments are falling in general in returns. It's pretty skewed, if you guys notice, where 65% return 0 to 1. 25%, 1 to 5. And in general, if you look at this, 65% of financings fail to even return just the 1x. Only 4% produce a return of 10x or more. And only 10% produce a return of 5x or more. What does this all wrap up to? Investors demand a much higher return for higher risk. And it sounds intuitive, but a lot of early stage companies think that there's money sloshing out there for their company at all stages. Here's data on seed-backed companies, and these are actual numbers. So 1,027 companies got funded. This doesn't include all the companies that tried and didn't get funded. So this is just the ones that did. Of those, only 40% made it to the next round. After that, 23%, then 9%, then 3%. So if you're an investor and you're looking at an early stage company who's over here in the group of 1,000 or 400, are you gonna want the same return that someone who's investing in a company over here is? No, you're gonna need to be much higher. And that's what this shows you. So that if you're an early stage company, and this is just guidelines and rules, but keep in mind that if you're brand new starting out, you really need to be looking to put together a use of fund strategy that's going to get your early investors a 10x return ultimately plus. And as you see, as you go through and you continue to get funding, what's happening is the risk of your company is going down. And therefore, the return that an investor will require will be less because the risk is going to be less. I'm going to hand it off to Chris to talk about valuations.
Thanks, Doug. So this chart shows that there's lots of different valuation methodologies, and there's two broad categories. On the left, you can see that there are traditional methods, and what that means is that if you have an ongoing business with predictable revenue, you're probably going to use one of these techniques. We're going to focus a little bit now on the technique on the right, which is methods for early stage businesses. And typically early stage businesses don't have a good understanding of what their revenues are going to be. So there are different methodologies that people deploy. You know, there's a rule of thumb method, a VC method, the Chicago method, a comprehensive evaluation method. And sometimes what startups will do, or investors will do, is actually look at a series of these and then value the company from different angles. So we go to the next slide. One thing that we need to understand is, like, what will drive those valuations? What will impact the valuations? Because when you're building your business, this is the thing to think about. So the multiples, there's something called a multiple. And what a multiple is a comparison to another business. So for instance, you might have a multiple of economic value divided by sales, or a multiple of EBITDA. And I'm using an acronym or a financial term, and I'm going to recommend, if people are not familiar with the term EBITDA, that's a term to get familiar with. And that's a measurement of earning before interest and taxes. So it's how profitable the business is. And these multiples are typically aligned by industry, by sector, by location, by revenue or size of company, and profitability. And those are things that we all know that you need to be in the right industry at the right time to get a good multiple. But then there's other things that you can impact with your company. For instance, the rate of growth. If you're growing at a higher rate than the industry, you can have a higher multiple. If you have a really good competitive advantage, or what Judy was saying earlier, a lot of intellectual property, that will impact your valuation. The quality of the team. If you have a really good team, then that can attract money. And also an entire team, which means everything that you need to be successful with this round of funding. The other thing is the macro environment. If the overall economy goes down, then it can impact your valuations. You can't do anything about that, unfortunately. And then the amount of revenue. So the larger your company, the higher the multiple. So for instance, if you're a public company compared to a private company, multiples of a public company are typically higher if everything is held constant. Then if we move to the next slide, the reason this is so important is that, unfortunately, as Doug indicated, 90% of startups fail. So, and there's lots of reasons why startups fail. This is a summary on postmortems of 101 startups that CB Insights put together. And you can see that there's a litany of problems out there. There's no market need, ran out of cash, you didn't have the right team, you were outcompeted, you had the wrong price, the product and business model didn't work, the marketing wasn't really good. So this is really unfortunate that this list is here, but what Doug and I are trying to do is trying to help you guys be successful. And we would be really happy if everybody was successful. And really all of this really can be summarized by your strategy, in my opinion. A lot of this is like, where are you putting your time, resources, money to get to that value inflection point? Okay.
One other comment on that too is, so if everyone notices, the number one reason that companies fail is no market need. It's 42%. But how many people know of a company that had an enormous market need for what they were selling and they had a problem getting cash? So really think about it. If you have a huge market need for what you have and you're the one who's providing it and the only one, you're probably not going to have a problem getting cash. So the number of companies that fail because they have no market need is probably higher than that. And I just wanted to emphasize that so everybody's thinking about that.
And just to emphasize on that point, Doug, is that the market need has to be really demonstrable. So you might think there's a market need, but you have to demonstrate that to investors. Like there's absolutely no doubt in my mind that if you have traction, and Judy and the team talked about what traction is, but if you have traction, you'll have plenty of money. I just was diligencing a deal this last week, and we're looking for deals, and traction will help you raise money. So if we look at the next slide, what we're going to start talking about is if you eliminate these risks and the risk goes down, the value of your company goes up. And remember, investors are looking for a 10x return at this stage of the company's development. So you kind of think about reducing risk by 10x and then value goes up by 10x. So let's look at types of risks that investors will look at when they are evaluating your company. So what is the size of the market big enough? Do you have a competitive advantage? Do you have product market fit? Have you figured out your supply chain? Do you have the right quality issues? Are there any regulatory issues? Is the technology disruptive or not? How long will it take from introducing the product to getting to 10% market share? And they'll ask questions all around this to truly try to understand, like, how much money am I going to make? If I give them $1, are they going to give me 10 back, $1 back, nothing back, 100 back? So that's what we're trying to do, is we're trying to give the investor the confidence that there's some chance that your company will give them the rate of return that they feel is commensurate with the risk that they're going to embark upon. Next. So we're going to talk a lot about strategy, and this book is a seminal work on the difference between good strategy and bad strategy. Usually in the startup world, people are not talking about strategy that much, and I think that's a challenge, because when we've looked at companies from the outside, when you're looking at it from sitting on the investor side, 9 times out of 10, we can look at a deck and say they don't have a good strategy. It just, like, maybe they'll develop a good strategy, but I know that they're not going to achieve my goals. So that's why this is really critical, in my opinion. And what is a good strategy? A good strategy it's not a goal or a vision. And if you think about a goal or vision, that's it. But it acknowledges the challenges being faced and provides an approach to overcoming them. The greater the challenge, the more a good strategy focuses on coordinating efforts to achieve a competitive punch or problem-solving effort. And if you read this book, you'll see how critical it is to be able to articulate within your 1-minute pitch that Judy talked about. Tell me how you're going to win in the marketplace against the competition with a value proposition that you possess and you're much better than your competition. If you can't say that in a sentence, you don't have a strategy. It's simple, but really hard to do. Next slide, please. Okay, so how can you set goals to drive value and creation and milestones? I'll turn up the volume a little.
Chris?
Hello, can you hear me?
Yep. There you go.
Okay, so there's an acronym called SMART that I'll talk about a little bit, which is really critical. And we use the same methodology, whether it's a milestone or a SMART goal. We use the term milestone to denote kind of one of the top 3 goals that a company is pursuing with this round of funding. What a SMART goal is, you need to have something specific, telling you specifically what you do. It needs to also be measurable. It also needs to be achievable or realistic. And then it needs to be timely. So it needs all 5 elements to make sure, like, this is exactly what you do. And if you go to an investor and you tell them that you have SMART goals and you tell them when you're going to achieve them, they will appreciate that, because that's what they're trying to figure out. And Peter Drucker has the most. Peter Drucker is a management guru who was one of the best in the business and had been around in the 60s and 70s, and everything he's written about basically has come true, from the knowledge economy to the importance of startups to quality. And a quote by him is, you can't manage what you can't measure. So you gotta manage, you have to measure what your goals are, and then you can manage to them, and then you have a chance of being successful. So if we go to the next slide, the next thing we want to talk about a little bit is alignment. And alignment, it's so critical. Doug and I's experience when we were running companies, we literally would have strategic planning sessions once a month. And most people think, like, oh my God, you're crazy. Once a month, that's too much time. And the reason we did that was so that we would have very high alignment throughout the entire organization. And that alignment, we know that if you're aligning the stakeholders, and that means the board of directors, the investors, all the employees, the chance of success goes through the roof. And if you're not aligned, and this is intuitive, if you're not aligned, then you're not going to be successful. There's no way to be successful. So within our software, one of the things we do when it talks about risk is we will survey everybody, all the stakeholders, before we start the process and then after we start the process. And usually when we survey people and we ask them, what are the biggest risks your company is facing? You could see the graph on the left indicates, in the score of 1 to 10, all these marks are different people within the company and how they rank a specific risk. There's some that rank it very high, there's some that rank it very low, and then there's an average in the middle of it. And there's a big distribution. So if you think about spending money to reduce a risk, you don't have alignment here. Whereas the score on the right, we now see an alignment. And now, if we're going to decide where to spend money, people are going to spend it in an area where there's consensus. So we work really hard to discover unstated assumptions and generate consensus around what the biggest risks the company faces, so that you can decide, okay, let's spend money to really mitigate those risks and increase the value of the company to the greatest possible degree.
If you guys have not read a book on alignment or done any discovery on it, Edgar Papke, who wrote this book and did a lot of work on it, it's spectacular, and I highly recommend it. Okay.
So let's go to the next slide, Doug. Thanks for stating that.
Yep.
Now I'm going to give you a few examples of what a bad strategy is, and then we'll talk about a good strategy in a few more slides. So one, we talked about the market size, and not solving a problem the customer will pay to solve is really critical. And one example of that is often it is a problem, but people are so busy today. If it's not one of the top 3 problems, they're probably not going to do it. So if you have a version 1 of your software and you can't sell it, and you think you're going to add a feature to go sell it, well, maybe that's not going to be the case. So make sure that spending more time on something that people are not paying for is not throwing good money after bad.
I just want to drive the point, because the way Chris tells it when we're in person is, hey, I got to finish version 2. No one's going to buy this if I don't finish version 2. Hey, is anybody buying version 1 yet? Why don't we try selling one of those first before we work on version 2?
Mm-hmm. Another example of bad strategy is often you see people putting together a great plan, they love it, and then what happens? 6 months later, you ask them, are you on plan? And nobody's even working on it. They're working on what they'd like, or what they're interested in, or what they're comfortable with, and that doesn't work out. You got to make sure that that your strategy is integrated into your operations, and in our case, that means your use of funds. Where are you spending your time and money? And the other important thing is you need to have a competitive advantage. When Mitzi was reviewing the competitive slide, if you don't have a product that is really compelling, and not 10% better, but it needs to be demonstrably better, people are not going to buy your product, because you're a startup. And if you're a startup, you're risky. Therefore, you need to be for a customer to accept that risk of a startup, your product needs to be much, much better. And then they'll move forward. Then you have a competitive advantage, and people will buy your product. The other thing is that obviously we're in a dynamic environment. If you think, obviously COVID has impacted everybody, and you need to change your plans when major things happen like COVID, or a new competitor enters the marketplace, or your product doesn't work the way you anticipated. So please always pay attention and update your plan when new information emerges. Yeah, this is a really critical point, which is often what people do when they're creating use of funds is that they will take a forecast, and then they'll put together a profit and loss statement, a P&L, and then from that P&L, they'll figure out what their use of funds is going to be. They'll say, I'm going to spend some money on hiring some people and getting a building and spending it on engineering, and I'll spend some money on marketing, but it's based on a forecast that is incorrect. Well, if the forecast is incorrect, your use of funds will be incorrect, and therefore you're going to probably not have enough money to accomplish what you want to, because usually the forecasts are more aggressive, and they typically they're usually about a year late based on our experience. And if they're a year late, you're going to run out of money. So I can't emphasize that you should not create a use of funds around your forecast. And then the other thing that's really critical is that if you don't have milestones that are related to value inflection milestones, then who knows if you have a good strategy or a bad strategy? You just don't know. So you really need to focus on a milestone for an investor that will increase the value of the company dramatically. Okay, so now let's talk about how to do that. So this is a typical use of funds process of how people often create it. So the first thing they do is they say, oh, I'm looking for $1 million investment. Okay, I do that. Then the next thing is say, I estimate some revenues. And then after that, I build my P&L. And after that, I think about how am I going to spend it? Okay. And then the next step is I will build a use of funds, and I'm going to decide I'm going to spend some money on product development, some money on sales, maybe get some office space. Even under COVID, we might need some office space. And I do some marketing, and I have a little bit for accounting and salaries. Okay. But it didn't ask this is what most entrepreneurs do, but it doesn't ask the most important question, which is how much did the enterprise value increase after spending the money, the $1 million? And this is what an investor wants to know about it. And that's why there's so many questions that typically occur. And the entrepreneurs are frustrated with all the questions, and the investors are frustrated with all the questions. So there's a new way to do, there's a different way to do this in a better way. So what's a good strategy? A good strategy is use a process that aligns all the stakeholders. So the second thing you do is you need to set SMART goals. The third thing one needs to do is prioritize the SMART goals by the highest risk-adjusted return on investment. And then we need to set the milestones to fund the next round. And I'll ask a question, and I because of this format, I don't expect to get an answer. But if you're going to raise $1 million, and then let's say the next round is, for instance, a $10 million round, and you're going to go back to the investors, what are the milestones that you need to set up in order to fund your next round? And often people say, I don't know, I want to raise $10 million, I'm going to spend this $1 million and then raise the 10. Well, what is the 10? Like, what is the goal? And what is the milestone that one needs to create that and to achieve so that the venture capitalists or the people funding the 10 million will say, you know what, I want to give you that 10 million. And I would ask everybody to think that through very thoroughly, because if you answer that question, you're 90% of the way there. And then you need to monitor and update progress dynamically, because we know that startups are very dynamic and things change a lot. There's new people, there's new information. So you need to always update it dynamically. And then the last thing that's really critical is make sure your strategy has a competitive advantage. And once again, I can't tell you how many times I perform a Google search and people say there's no competition, and you're like, boom, here's a competitor. Or you say, people are really concerned about this is a huge problem. And then you find out it's number 12th on the list and that nobody will pick up your phone to talk to you. So these are all the elements that are critical to have a good strategy. Now, if we look at a process to go and create one, this is the risk to value process that Doug and I have created software around. We have patent pending on it. And the first step that we do is we say, what are the risks that need to be mitigated? The second step is, what are the SMART goals will mitigate those risks? And then the next step is, what is the cost of each one of those SMART goals? Because some things are going to be expensive and some things are going to be less expensive. And then you need to estimate the increase of each one of those goals. In other words, like for instance, getting an office, that's not going to increase the value of your company, or hiring a salesperson, that's not going to increase the value of your company. But pick a goal that's really going to increase the value of your company. Like for instance, getting that first purchase order or getting that letter of interest. Those will increase the value of your company. And then you calculate the return on investment of each one of those SMART goals. And then you prioritize those SMART goals by the highest risk-adjusted return on investment. And then what you have now is you have a forecasted P&L, you have a forecast increase in enterprise value, and you have a forecasted risk-adjusted return on investment. And the forecasted risk-adjusted return on investment is so critical because that's what investors care about. And most entrepreneurs don't have what's really important. It's the balance sheet, right? You have a P&L, but you don't have a balance sheet. So we're trying to help entrepreneurs really understand what investors want, which is, tell me how I'm going to make money. And the only way to do that is with a forecast, just like a sales forecast related to the enterprise value. So
one way to think about it is no one's going to buy your revenue. No one's going to buy your revenue forecast. But what value on your balance sheet does creating a revenue stream that's repeatable actually represent in value on a balance sheet? And that's another way to think about it.
a great point, Doug. Thank you. So here's a cartoon example that we put together. Here's a bunch of risks on the left-hand column. So you have competitors. Is the market big enough? Does the product actually work? Can you execute well? What's the adoption rate? If it's really slow, then investors won't make the return on investment that they want. Is it brand recognition? Is it IoT capable or not? Like maybe for some, in this case, some people want it to be IoT capable or not. And then we've listed a few SMART goals that will mitigate it. Like you file patents, you do customer discovery, which means you go talk to customers prior to asking them if they would like to give you a purchase order. Maybe you create a demo, you add team members. Would you obtain some advanced purchase order? Maybe you hire a branding agency, or you create version 2.0. Then we've estimated some funding amounts to this, and you can see it totals more than the 1 million that we wanted to raise is 1.4. So we all know we can't do everything. So we then look at the next slide. What we can determine is that, you know what, these estimated increase in value are not all the same. So we spend $1 on one thing, it's not the same as spending $1 on something else. So in this case, we've done some quick calculations on ROI. You could see like the IoT capable version, you're going to lose money on that. That doesn't make any sense. Whereas the adoption rate, that's the biggest risk. So if we spend a little bit of money on that, and we can prove that the adoption rate will be fast, that ROI is 17x. That's a really good ROI. So if we go through all of this, though, if we spent the 1.4, the value increase we estimate is about 10, and that's a 6.8x. That's really not good enough. So let's down select, and let's not file a patent right away. When we file a provisional, but we don't file the entire patent. And the brand recognition, not yet. We're not going to do that yet because we can go talk to customers without that. But the IoT capable portion of it, we're not going to do that either. So now if we down select, we spend the $1 million, just like in the previous example. The increase in value now is 10 million, but the ROI is almost 10x. So we've gone from around 6 to around 10, which is a big improvement. And now the investors are like, oh, we're in the ballpark of what I want for return on investment. Okay. So Doug, can you share a little bit more about how we do this in reality?
These are sanitized examples of screenshots from how we do it in the software. And sorry, my fingers are fast. So it's going to be harder to see some of the detail. The important thing to look at is this is a use of funds roadmap. And this is identifying what the 3 biggest milestones, the 3 biggest SMART goals, as Chris said, are just the 3 biggest things that are going to increase the value of the company the most in each round of funding, and approximately how much they're all going to cost. And we talked about how every investor knows you're going to need more money. If you walk into them and say, look, I'm raising X amount now, and I know that I'm going to need more later. I'm not exactly sure when I'm going to do all these, but I know that these are the big milestones that have to be done. And here's a roadmap that hangs together as to potentially one scenario. But what I do know is that I got to focus really on maximize my value right now in the current funding that I'm in. Because if I can do that, I'm going to minimize my dilution later on in rounds. And so this is just each round as we have set a plan out. You've got a seed round with 3 milestones, a pre-seed, a seed round, an A round, a B round. All companies have different funding roadmaps, some in different sectors. if you're in a drug or therapeutic, it's got a whole different roadmap that's a little more unique to that. But in general, they all look like this. What are the 3 biggest things I'm going to accomplish? What's the money I'm going to use? And the next answer everybody wants to figure out is, what's it going to be worth? And so what this does is it takes all the calculations that Chris was talking to you guys about and walking through and how to plan a strategy and down select to get to the biggest ones. And this shows you that, as you notice, if we create a plan that creates a huge value inflection in the beginning, we're going to see the biggest increase or the biggest ROI in the beginning. And as the company matures and de-risks, the slope of this line is going to go down because we're going to demand, or the investor will demand, a smaller ROI because the risk is less. Now, there's 2 lines on here. One's blue and one's green. The blue one is just the gross expectation forecast for what the return on investment can be. The important thing that isn't displayed here is that these are in ranges. There's no way to be precise about this. And especially when it comes to early stage companies, it's about making the best relative decision. It isn't always about being precise, and you can't expect to be. But what important here is that you've just got a gross expectancy of what you think it could be worth. When you sit down, you go through and you say, what is the real probability of me accomplishing this? Even if I had the money and the time, it's not 100%. It's never 100%. And so this takes into account what every investor is sitting in their head going and thinking, okay, yeah, that sounds great. This blue line, that's really high. I love it. I love the story, but what's the risk? And if I take the probability and I think about the risk adjusted return on investment, it's lower, and it's probably around green. But if you take a look and you can create a use of fund strategy that even has a risk adjusted ROI, that's really good. That's what I want to see. That's what every investor wants to see is, yeah, I know it could be huge, but given the risk you're taking, is it still meet the threshold that it's worth investing in? And is in essence what will make it fundable. And so this lays out, just as we talked about on an earlier slide, at every stage, the investor is going to expect a different return. And if you think about all over here, this is a private equity firm that's going to buy it and try and turn 3x out of it, and then they're going to turn it into an IPO. And that's what this late stage is, to put in perspective. Versus on the left is where VC is going to kind of come in and seize your company to get this huge value increase out of your first 3 milestones. Okay. This is when you drill down, let me just take you back. So we have a whole milestone roadmap that we built. We talked about having milestones in every round, how much we were going to spend, and only on the most important milestones. When we drill in, and in the current round is what's really important, we want to see exactly what we're doing. And that's what this one shows you here, which is these are the top 3 milestones and SMART goals that are detailed cost analysis. So here's milestone 1, milestone 2, milestone 3. Here's the total theoretical cost we budget for them, and here's the major SMART goals. And if you notice, there's even probabilities of completion as well as estimated costs. Now, we do ranges for everything because, you just don't have the information to do precision. And again, a forecasted range and making great relative decisions of what this is all about. And so this is where you drill into detail to be able to see what you're really doing to create those huge value inflections out of this specific round. Okay, so there's a lot to take in on this slide, so let's just go through it real slowly. This is a theoretical enterprise value increase roadmap that would have been created from all of the slides and inputs that came before this. And so what this shows you is in each of these rounds, the red is the amount invested, the blue is the enterprise value increase without taking into account any probability for completion, just what do we think it could be. And the green, again, is taking into account those probabilities. So we have costs, we have a forecasted enterprise value increase range, and then we have a risk-adjusted one. And as you can see, we see an ROI, risk-adjusted ROI in each one of these rounds, and this is what your enterprise value increase roadmap looks like. Now, there's a lot to digest on this, but the big takeaway is to look at this slope, which means you're going to invest money to crank up the valuation as much as possible, to keep doing it again and again and again. Chris, you have anything you want to add on this one?
Yeah, so the only thing I'll add is that enterprise value, for those of you who don't increase it, is basically how much the company is worth, or the incremental increase in value of the company. So that's one important point that I'd like to make. The second point I'd like to make is that this is a real life example of a client of ours, and we had to keep some of the data confidential. So thank you everybody for your indulgence in this. Those are the only 2 points I'd like to make.
Okay.
So Chris, we do have a question which I think is very appropriate right here.
Okay.
Nate is asking, can you explain the difference between revenue and value?
Great question.
Yes. So revenue is how much sales you have. So a profit and loss statement basically says that you have a certain amount of revenue, and then you have a certain amount of costs. And then the difference between those revenue and those costs is the profit. Now, that's the P&L. The balance sheet basically is all the assets I have, all the liabilities I have, and the difference between them is the value of my company. The enterprise value is basically a subset of that. We're saying specifically for these sets of activities, for us, how much will the value of the company be increased? So that's a very simplistic overview of the difference between a P&L, a profit and loss statement, and a balance sheet. And so a balance sheet, in essence, is the value of the organization. How valuable is the company? So so another way to think about a balance sheet is that when you say you have a unicorn of $1 billion, that means the company is valued at $1 billion. And if there's any other questions, this might be a good time to ask them. So please, Maggie, if you have any other questions, Doug and I would love to answer them.
While you're feeling that one, another way to think about that too is, you know, what would you pay for a one-time amount of money versus what would you pay for a machine that just printed you money every year? Value is what the machine's worth that's going to print money for you every year versus what revenue was one time, one moment in time.
Okay, so 2 questions. You mentioned an alignment book by the fella Papke, but we didn't get the title of that book.
It's Edgar Papke. If you look it up, it's called Alignment. He's got one.
It's just called Alignment. Okay.
Yeah, just look for it. Yeah.
Okay, and David is asking, where is the value coming from and how do you calculate it? So the valuation is, you talk about multiples in different industries. Maybe that'll help.
That's a great question. So Doug and I will answer both that question. So that's one of the core competencies of ArScientia, is estimating the value increase of an enterprise. And so we showed you the funding roadmap. And then what we do is we take a comparable, a company that is in the same industry with the same sort of product, and we looked at how much funding they typically achieve over time. That's one thing that we do. The second thing we do is when we look at comparables, there's things like, you know, a multiple, and so those multiples will help us determine the valuation of a company as well. And then we break that down with proprietary databases, which we pull all this information together, and then we estimate the value of the specific milestone, and then we go down a level and estimate the value of the specific SMART goals. And there is definitely an art and science to doing this, and there's a range. And one of the artistic part of it is you have to do relative ranges to begin with, or relative values to begin with, and then with time, and as your company gets more and more data, that range will decrease over time. So that's how you get the valuations. A way for startups to get it is to look at the comps and to look at how big the market is and to look at how relative you are within the marketplace. So it goes back to the valuation slide that I talked about earlier. It's all that information kind of wrapped up together.
And all of this is based around option theory. We got chopped up in the intro and on the voice problem. But at the center of all of this is thinking about optionality and option theory. And that's where a lot of that comes from. And in option theory, and when you start talking about volatility, it's never a precise number, especially in the beginning. It's always a range. And so these are methodologies and things that are done with sophisticated financial instruments that we've adapted to be able to use by early stage companies in this way.
Yeah, so that went over everybody's head.
Yeah, I just want to emphasize that a little bit. So Doug taught option theory at the Merck, and the Merck is the center of option trading in Chicago, in the center of the world. And these are phenomenally sophisticated tools. And what Doug and I are doing is bringing them down to the startup world, because they're the way sophisticated investors make intelligent decisions. And we're trying to bring our mission is to bring that knowledge to the startup world, because we think people making decisions like that will be much more successful. Going back to that slide where we said 90% of the startups fail, our goal is to make sure that nobody fails. That's our mission. And what Doug meant by, option theory, it's really simple. It's like, where do I place a bet and how big a bet do I place? And some people are in Reno, some people are in Vegas. So I'm sure that metaphor makes a lot of sense. If you're playing, different, if you think the bet is risky, you can bet a little bit, but you're not going to bet everything. And so we're applying these principles within the software, eliminating it from everybody to see it, and simplifying it. So the simple version is, look at your risk, look at the value of your enterprise, and place little bit of bets along the development of your company, so that you will have you'll be successful in the end. So that's another way to think about it. I'm sorry that we don't have a better explanation of option theory. We try to keep it under the hood a little bit. Did that help, or should we try again?
No, answer this question.
I like the way you handle. I like the handling. I just wanted to get that out of the way.
So Joey says, would a subscription model provide a higher potential value compared to a one-time sale product?
Of course, absolutely. That's a great point.
Right.
Because it's repeatable, it's predictable. You have an asset that's going to print this money, and so I would pay more for that. Absolutely.
So right. I'd like to. So now I'm going to teach entrepreneurs the challenge of talking to investors. So,
that they talk a completely different language.
Well, besides talking a different language, you can talk to two investors, and one will give you one piece of advice, another investor will give you another piece of advice. And I'll give you an example. So one investor might tell you, you know what, you need to really focus on one market. You have 4 markets here and focus only on one. I don't want you to focus on many. And the next day you go to another investor after you've decided to focus on one market, and he or she is going to tell you, you know what, why do you only have one market? This market's not big enough. You need to focus on what's your next market. What are you going to do after that? So you can't make everybody happy. Doug likes SaaS-based business, as many, many, many people do. About 25% of all startups are software-based. And for some software, I would agree with him. But if it's a small market, you know what? The value is not going to be that high. I have more experience in the hardware space, and we made so much money. It was incredible. So it depends, right? And not that Doug is wrong, but it's a much more nuanced and complicated answer. Sometimes, in general, he's right. Software does offer a better return. But I know hardware companies that make a ton of money. Apple's an example.
To illustrate this, can you give us what the typical multiple for a SaaS company is in a mainstream enterprise type of SaaS versus the multiple for a hardware company?
Chris, so where you are on the spectrum is really important. So when valuations aren't based on where are you today, what do you look like today, wow, that's a beautiful picture, I'm going to buy that picture today. They always build in the forward growth curve. So It is a really loaded question, and people hate the answer because it's a depends answer. And so let's say that you're at the point where you've got a ton of traction, but all of the market share that you're about to grab is yet to be grabbed. Well, that's going to get you a much bigger one than if you've already grabbed a lot of that market share.
So
And
what
so-
Doug is saying, like an example is, if you see a multiple for a publicly traded company that might be 60x, people say, that's ridiculous. The average multiple might be 18x. Well, the reason it's 60x is because they have 5% market share and they're growing at 25% a quarter. And people expect them to keep growing. I mean, everybody's seen Amazon was losing money for a decade, and people said, how can people keep investing in that? Why does the stock keep going up and up? It's because people thought that they have a long way to go in terms of growth, and they were right. They kept investing and they kept increasing market share as they captured more and more online sales. So the question, I just want to point out the question. They said, what's better, hardware or software? It depends.
The question was, what are the typical multiples in those industries?
Those are not industries. So there's no, you need to click down like 3 layers. So what type of hardware, what type of software, how big is the market, what's the growth rate, what's the team? So there's a ton of questions to answer. So we're not trying to be evasive, but you could say it's 15 to 30, or it could be 5. So
and if you want to, yeah, sorry.
Like for instance, if there's a software company with $1 million in revenue and the sales are going down, then there is no, the multiple is really bad. If you're in a hardware company and you're like this hardware company I was working for, our revenues were increasing 50% per quarter, not per year, per quarter. And our multiples were through the roof because we were doing that. So it's the typical number. There is no typical number. There's a range, and the range is very different for hardware and software companies.
Okay,
And there's data out there that will give it to you. Like there's SaaS reports and technology reports that will tell you where the biggest multiples have been recently, whether they're A rounds, B rounds. You know, they'll tell you where private equity is coming in paying multiples.
So that is kind of the point I was trying to get at. There is research available out there so that if you're in a specific industry, there are typical multiples.
Maggie, we're having a really hard time hearing you.
Talking right into my microphone.
So Maggie's right. Actually, PitchBook verticals, if you go look for PitchBook verticals, there's some information there. I don't know if you can hear me better, but there's data out there to go out and find out what they are, or find out the ranges of what they are and at what stage the companies are in. So the data is out there.
Okay, and can you hear me now, Doug? I have another question.
Yeah.
Okay. So Nate is asking to expand on the profit value question for pure software companies that don't build up physical assets.
Let me go back real quick, because there was some chat about sneaker companies and apps and all this other stuff. At the end of the day, I don't care whether it's software, it's a service, it's a tennis shoe, or it's a brick, okay? If it's an enormous market and a huge opportunity, it doesn't really matter. So to keep picking on a specific one is less important as how big is the opportunity and what you're looking at.
Okay, that's what all of these entrepreneurs should be considering. How
Right.
big is my market?
How big is the opportunity? Not whether right. It doesn't matter if doesn't matter what it is. It could be a huge market for trash bags. No,
Okay,
I mean,
Chris,
there's a huge market for trash bags. We know someone who's the trash bag king.
Chris, back to you. Do you want to take a little break now, or are you still in the middle of something here?
We should power through.
Let's keep going.
Okay.
Okay, so, well, are there any more questions right now before we continue? And
No, they've slowed down. I think that you're ready
Okay.
to go.
Okay, so this is, we want to bring your attention to a couple things right now. So first of all, if you go to our website, we have some free resources. We work well with an agency called Turn. If anybody needs any help in that regard, please reach out to them. They have startup friendly rates. We also have some marketing terminology. When people talk about TAM, SAM, SOM, that gets really complicated. That's really critical on understanding that. One of the most critical things for startups is traction, as Judy mentioned earlier. We also have forms for how to create a deal room. We'll talk about a little bit later. That's on the website. And obviously there's the investor summary builder with an ROI calculator. So all these things are complementary. Please take advantage of them. And then we just want to summarize this section by saying, you know, what R2V will do is it's help you raise money faster because you're speaking investors' language. It will also increase the probability of a successful exit because you're going to be spending money on value inflection points. And the thing that's most rewarding to Doug and I is that if you maximize your valuation at each round, you're going to minimize the dilution as an entrepreneur, and you're going to hold on to your company's value, and you're going to make some money. I'll tell you a little bit of a sad story just to see why this is important. We know companies that get sold for, let's say, $50 million, and the entrepreneur gets zero because they got diluted out. And that happens, unfortunately, a lot. And we don't think that's fair. And so we're really trying to help the entrepreneurs be successful. So we do have, we told you we have the software. It's not public right now, it's private. We're doing betas, and we've decided to open up one additional beta to people within the Startup Nevada challenge. And if anybody would like to be a paying beta client, they're willing to shoot us an email. You have all of our contact information, and we'll evaluate that and try to help you out. Right now, the software is in a state where it's an expert system, so Doug and I work hand in hand on helping you create a fundable plan.